So Lemonade's Q1 2025 results are coming in on Tuesday, May 6th, prior to market open. This is a little bit different this quarter. Generally, they release their earnings letter the evening before, the afternoon of the day before, and then they host the conference call the next morning. I think they typically did that because of split teams between New York and Tel Aviv. But this quarter, they are releasing the letter and the call all at the same time on the morning of. So in this video, I'm going to give you my preview for Q1. Now, first of all, the timing and release of that, I think this ties back to probably feedback by Neil, by Vision, otherwise known as Investor Daddy on Twitter, talking about, hey, Neil's pointing out there are sometimes these after-hour drops on low volume where people try and maybe discredit what they're doing or cause confusion in a low volume environment to manipulate the stock price, cause some fear. So by tying it together, we'll see if that can more avoid that kind of a situation or potential for manipulation. The only one small drawback I see of doing them at the same time, or advantage that you no longer have, is when it was released the day before, the letter that is, it was nice because we as investors could digest it, post questions maybe on Twitter, on X, and management would sometimes or often even address those questions if there was major concerns from one day to the next. But also, I can see the positive of this, you don't have that time of sort of the overnight time where you have possible confusion, possible FUD that gets thrown around. So it's interesting. It's nice that they're trying something different, so we'll see how that goes. Now, there's two main things that I'm expecting from this call. This quarter's results. One is more information about the LA fires and their impact. We're going to see the loss ratio that came in because of those fires. And then the second thing is just steady progress in all parts of the business, and especially steady progress in car. More updates on car. Each quarter we should learn more and more about how car is going, how all products are going. And for the start of this video, I've highlighted a number of clips, information from the earnings call of last quarter. So I'm just going to read those and give a little bit of commentary. First of all, about the LA fires. It was mentioned in the earnings call. I'll leave the full coverage impact of the California fires to the next quarter's earnings report. But what I can already say is that our cautious underwriting and product geographic diversification, reinsurance programs, et cetera, has... Even though some analysts thought their loss may be north of $200 million, it's more like an EBITDA loss of $20 million. So, as we heard in last quarter's results, fires were not that significant of an overall loss, not a existential threat by any means. But we'll see more detail about the fires. And here was another little bit of information about the fires from last quarter. As Tim mentioned, or was answering a question, said maybe on 850, 900 claims, 90% of those claims, related to the fires, 90% of those were for the were renters, and then maybe 30 or so large home losses, which really dominated what the losses could be. And then he also said reinsurance protected them, so they really only had maybe a $20 million EBITDA loss. And then why do I expect that we hear more about car? Well, flipping ahead, another part in the earnings call, it was said that it's still early days on some of those tests. They're talking about different car-related tests and tinkering they're doing. But we expect to cover these topics in more detail in upcoming quarters. So each quarter by quarter, I'm really expecting that we'll continue to unpack more and more the car thesis and how the car story is going and see hopefully a steady march of progress in terms of improving the product, improving the automation of the product, and improving the unit economics of the product and the growth of the product, of the car product. Next note about the car that we'll flip to, just highlighting this. Daniel is saying, he's giving a metaphor about car. He's answering another car question. He says, until we feel we could scale this business, car business, by hundreds of billions rapidly and ultimately by billions of dollars without it causing a degradation to our underlying business. Basically saying we're not going to really accelerate, really take off until we feel we could do that without hurting the underlying business or overly straining it. So my guess is the car, they're still tinkering with the overall flow of the product, with how automated the product can become, and improving different aspects of the product, the sign up process, questions customers have, understanding problems with the product people have, and figuring out the root causes of those and uprooting them, and claims process, improving that. All those different processes that would go into the car product, my guess is they're still being tinkered with and improved, and as those become better and better and better, we're going to see a continual ramp of the car product. And then another comment again about car says, as we now are approaching 2.5 million customers, we've been testing for some months, some quarters, different avenues which to trigger. We're getting a continuous improvement in our upsell, cross-sell of car to existing portfolio. And I'll talk about that in a second. This requires fine-tuning, getting exactly right, getting the pricing right, playing with the levers of conversion. We're seeing tremendous progress. So again, they're continuing to ramp up the car product, and we're going to see, I think, each quarter more and more of that unpacked. As he even says here, perhaps in our next shareholder letter, that'd be this quarter, or shortly, we'll give a deep dive into all the progression that we've seen in the past few months. And then another interesting question about car, I know myself has had, others have had, maybe we'll get some color on, is in this quarter's results, is a question you have is, how do you use telematics? How do you give someone a price that they want at the moment of conversion, a fair price for someone, even before they've driven for 30 days or so, usually needed for telematics to give you a true read of their behavior. So that is something I've wondered, and maybe that'll be just this one specific thing. There's lots more, but that is one specific thing I'd like to hear more about, how that works in their side of their car product. Is just, if you have a customer and you want to convert them to car, how do you know what price to offer them right off the bat without having them? Is there a way to get around that or accurately predict what their pricing would be even before they've driven 30 days, or to seamlessly help them, do a driving test period that's so seamless? Maybe it's just on your phone, you just having that Lemonade app with other products that it turns on, and you allow it to turn on and track your driving even before you really even thought about or wanted the car product. It's just an interesting question, detail angle around the car product we maybe get color on in this quarter or another future quarter. And then more of the same commentary about cars. The reason we're taking extra few quarters to get the pricing, filings, messaging, advertising, everything just so is that we want, when we do unleash it, be able to grow it effectively in a profitable way. So again, they're still telling us, hey, that car is improving, but it's not full throttle yet, and eventually we'll get there, but it's not quite there yet. All right, so that's my summary of some of the main best comments from the earnings call last quarter. Again, we're going to expect this quarter, we're going to hear about the LA fires and their impact as well, and how Lemonade was able to handle them effectively. And then also we're going to hear hopefully more information about car. So now looking at some of the numbers for the quarter, we have their guidance for the years at IFP at the high end was $1 billion. We have adjusted EBITDA loss of $49 to $46 million. But if you look at this was on March 25th, so a few days before the end of the quarter, Lemonade passed $1 billion in premiums. So already was at least past that high $1 billion mark on March 25th. And then flipping over to my Lemonade model, I'm projecting from Shai's comment here, since they passed that 6 days before, if you do sort of the math, if they continue on that trajectory, they would finish the quarter at about just $1.4 billion. So just over $1 billion of IFP, something like that is what I'm predicting. Now, if we think about the gross loss ratio, I want to give a quick shout out. Shout out to Prin here, one of my Patreon supporters, and in my Discord there. If you want to join my Patreon, support the channel, I'll put a link for that. But he broke down some thoughts on the loss ratio. He does that every quarter. And what they pointed out is Lemonade said from the California wildfires, they had about $45 million in gross losses. And say they get to $1.4 billion, like I said, of premium, and that might have gross earned premium about $241 million, and say they do $45 million in losses over $241 million. That means maybe about an 19% hit to the gross loss ratio that could be coming in Q1. So if we think about, if I flip back to, so that's at a 45 million there, but also it shows in their last letter the catastrophic portion, has been about 1% last quarter overall. This is nothing to do with the LA fires, but just a general catastrophic event, 6%. If we assume, say, maybe it's 1% or a few percent here for catastrophic events around the country other than the LA fires. Maybe it's 4%, and maybe the gross loss ratio ex cat is 61 or 60%, or maybe something like that. It's called 60% because because the products continue to improve, their pricing improves, new prices kick in, so maybe that continues to trend down. Maybe that's 60%. Maybe you have 4% of other, non-LA catastrophic events. You might be at 64% plus the LA effect. So maybe it's 60 plus the 4% plus 18% or 19%. You might be somewhere probably in the low 80% gross loss ratio range. So I put in, if I put in 82% right now, we'll see how that comes. I don't know if it's worth, trying to perfectly predict a number like this. You kind of know maybe it's going to be 82%. Maybe it's a little bit higher, as high as maybe 86%. Maybe it's lower, maybe as low as 78%, something in that kind of a range. That's probably accurate enough for what we care. The market knows the LA fires happen, knows there's going to be a hit here. If it's something way worse, it's 95%, well, then we have a problem, or we're greatly, misunderstood or misread something. But my guess is we're going to be somewhere kind of in that range, and my guess is the market's already, somewhat expecting that. Some other values here, I'm putting in a churn of 16.5%. If I flip back to the top two, I have about 81,000 customers growing there. Premium per customer growing about 3%. Last Q1 it grew about 2.7. As CAGR kicks in, I have to fine tune some of these numbers down through the rest of the year. But as CAGR kicks in, they should see premium per customer continue to more aggressively rise that value. So anyways, but churn, last 3 quarters, customer churn has been somewhere in the mid-16s, at 16.5%. Growth spend, we know that last year, or at Investor Day, they said they're going to spend about 40% more on growth spend than the year prior. So last year we were at about 121 million. So that means they might be spending 169, 170 million on growth spend. That's the portion of their advertising that goes directly to acquiring customers. Right now, the way I have it is about 33, 34 million this quarter, up from 20 the year before. We'll see how that goes. I have 165 instead of 170 for the year, but again, I got to fine tune maybe some of these numbers through the balance of the year a little bit more. And I have that converting. This is sort of customer acquisition spend dollars converting to IFP, excluding cross sells, which I have down here below is 32% of IFP coming directly from cross sells. Again, that should start creeping up as cars rolled out more as well, which helps unit economics. But I have that about at 1.9. You can see it was 1.7, 1.5, 1.9, 2.46 over the last few quarters. Partly this is going to maybe be worse than the year prior, because the year prior they only spent 19.8 million on gross spend. Now they're spending a lot more, but also as car products ramp, you have more products, more places, you have better advertising schemes. You can also continue to have good unit economics, so maybe this is even better, but we'll see. Then I have other insurance growing at a small pace, tech basically flat, G&A I have flat this year as they can hopefully continue to have strong operating leverage. And you get down to, I have an adjusted EBITDA of minus 46 million. This is versus, if I flip back to their guidance here, they had at the low end minus 49, at the higher end minus 46, and often they'll land in there or even beat that. So you kind of wonder, maybe the unit economics are better. So you kind of wonder if the unit economics some of these might be better. Say this conversion rate's a little more positive and it's a 2, and then they actually don't need to spend as much on a marketing to get to the same IFP. So you're saving money, and maybe you have a $45 million adjusted EBITDA, loss, something like that, and you have a little bit of a beat. I could definitely see that. You could see maybe the gross loss ratio is actually, in the more positive sense, it's only 78%. And maybe you have a minus $40 million loss. Maybe the gross loss ratio is worse. Maybe it's 86%. And now you have a minus 49 range. Flipping back, where was that here? Now you're still kind of in that range, but at a little more, at the higher end. But I think more likely it's, if I had to guess, maybe we're in that sort of low 80% range, the gross loss ratio, and then your adjusted EBITDA is maybe at the higher, somewhere in the higher end, maybe even a little bit above the higher end of what the guidance was showing. And I was a little bit late on my say questions this year, but I asked 2 say questions. And one that I had asked the previous quarter as well, but didn't get enough upvotes, but I still thought it was a good question. So I said, in Q4 2023, 30% of sales were cross-sells or upsells, and about 4.5% of your customers are multi-line. What's the expected cross-sell rate as CAGR ramps? So what will this go to? Because I'm actually putting this in my model. Does this jump up to 36%? Does it go even higher? What could that kind of look like maybe in more markets where CAGR is? And then, or as it's ramped up. And if you think 5 to 10 years out, what percentage of customers do you expect to be multi-line? And where do you see premium per customer going? So just getting some more details, because this could really help our modeling. It would be great if they did upvote those. Anytime I submit questions, I try and pick questions that I know could get us some detailed answers, or try to get detailed answers and help us think about in detail how they're modeling and thinking. There's a lot of questions that get asked on Say that are really just sort of basic, blasé, like, what do you think? Where do you see the company going in 10 years? And it's way too vague to get to really be valuable, I find, if it's answered by management. Or they're questions that have been answered 5 times before and would just get a similar answer. So you don't learn a whole lot, I find, if those sort of questions end up being upvoted answers. And then the other one I said, how do you assess the potential impact of tariffs or tariff threats on the business? In particular, how would they influence loss ratio, CAGR rollout, overall growth timelines given at Investor Day? So obviously, in the last few months, there's been lots and lots of tariff news and tariff threats and tariffs implemented, and concern about that especially on the loss ratio for insurers. So wondering how that might affect loss ratios. I don't think myself that tariffs are going to be too bad, but I am wondering. I'm curious to hear what their sort of take or perspective is on them, and they very well may give them in the letter, even if we don't ask this question, but we'll see. Now, just looking at some of the top voted questions, the first one of the top ones, 18 votes, 38,000 shares. Lemoande has made progress towards reducing losses, adjusted EBITDA losses narrowing. Can you elaborate on the timeline for reaching adjusted EBITDA profitability? I don't know if this is a great question. No offense to the author, no problem. I mean, it's fine. It's not, I've seen much worse ones, but we already know they've said many, many times that the timeline for adjusted EBITDA losses or break even is 2026. In fact, in the earnings call, it was said in the past year, 2024, we're still on track. So we have been for 2+ years to be EBITDA positive exiting 2025. That will be followed by what we expect a continuing EBITDA positive. And then I actually got excited when I was reading this because I thought, did I miss 2025? No. He says, I'm sorry, I said 2025. 2026 is unchanged. So He's saying somewhere in 2026, maybe it's later 2026, they expect to be turning EBITDA profitable. And this has been the consistent message for some time. So I don't know. They might get an answer on that just because it's more upvoted, but I think we already know the answer. Next question is about the maturity of auto insurance and some of the experiments. Again, as I said earlier, I think we're going to get information on this in the letter in the quarter, but also, could be a good question if this does get asked. This one, another one, where do you see Lemonade in the next 10 years? I mean, they gave us a vision for this. It's just way too vague of a question. I hope we don't spend time trying to. I hope we get answers to questions that are much better, because this is just way too vague of a question. You might as well just go watch the Investor Day presentation, and then you have the whole answer in a several-hour answer to that question. Cybercat, shout out to Cybercat. With rising tariffs, geopolitical tensions, inflation concerns, has Lemonade's growth plan or timeline to achieve 30% CAGR changed? Are you still confident in your targets, or how are you managing potential costs and expansion risks? Super, super awesome question by Cybercat. I'll have to go through these later, but I'll probably give this an upvote because this goes back to my own tariff question, but I even liked how he phrased it here, a little bit more specific in some of the details he's trying to sort of uncover from them. I already looked at this question of mine. But overall, I'm just excited for the quarter, excited to see the results, excited to see a steady march. We should continue to see a steady march of progress. And I shared this on Twitter, on X. It was a while ago, but it looked at the present value of all customers. It takes the estimated lifetime value of the customers, multiplies by the amount of customers. You can see as LTV has been aggressively growing and the number of customers are growing, the present value has been skyrocketing. And it'd be interesting to see how this continues to expand in the coming quarters, which we sure it will. Another metric I've looked at recently, or maybe in the last month or so, it was adjusted EBITDA minus customer acquisition costs. So EBITDA minus customer acquisition costs. And as you can see, if you take out what they're spending on customer acquisition for Q4, they were already in the positive. Now, I expect this is probably going to flip negative in Q1 simply because they have the LA fires. That's going to hurt their profitability. But then I think this will continue to flip positive and only march further and further upwards into the positive. Of course, you have to factor in your customer acquisition costs as part of your EBITDA, of course, part of the cost of doing business. But the point of looking at this is if you imagine your customer acquisition growth spend is part of almost something you could depreciate as sort of a long-term expense that you're spending for. You're spending all the cash for now, but really bearing, receiving the value from for a long span of time. So for Lemonade, if you strip that out, they're already positive, and this is only going to march upwards and to the right. And then if you flip to adjusted EBITDA itself, you can see that, we've had some lumpiness in the last few quarters, but part of the reason why this trajectory is not moving up faster is because they had, over the last several quarters, they progressively increased their growth spend. So if I flip over here, I think I have a tab that shows just growth spend. So as you can see, over the last, in 2023, they spent very little on growth. And then it's a high inflationary environment. Your loss ratios were higher than you'd like. And now 2024, they're all improving, and they're spending on growth. And this growth spend, they're going to spend 40% more in 2025 than 2024. So this will just keep going up and to the right as well. Dollars you're spending, but all those dollars you're spending, of course, are every dollar you spend is every dollar that's subtracting away from your profitability, so it makes your adjusted EBITDA look worse in the present quarters. And this is one of the simplest sort of Lemonade bear arguments you hear again and again and again, that, oh, look, they're spending all this money on growth, and look, the numbers aren't really turning around. Well, it's because you're spending so much on growth. And if you stripped it out, you'd see much more of a consistent up and to the right line. And you'll see as they're spending more on growth, your EBITDA minus CAC, because the CAC's not factored in, but your EBITDA keeps getting better, is going to keep scaling up. Because if you keep spending money in a profitable way, a profitable LTV to CAC unit economics, well, unit economics are going to eventually flip to the positive territory, or the overall company economics, I should say, are going to flip to the positive territory. Okay, I think I've talked long enough. Hopefully you got a lot of value out of this, and we're looking forward to the results next quarter. If you enjoyed this, you want to support the channel, feel free to join my Patreon. And thank you so much for watching. Remember, it's in the bag.